Last week, Main Street presented the quarterly earnings report, and things are looking really interesting. And this company is known for paying a solid monthly dividend. For many people, one of the main reasons to invest in this company. But what if I told you that you were better off owning the S&P 500 in the past 5 years when we look at total returns including dividends? Well, obviously, many companies fail to beat the S&P 500. That doesn't necessarily mean that you should avoid these, since the future might be very different. So let's see what Main Street showed in their earnings report. When we dive in the investor relations report, we see immediately the dividend growth streak. This is something they are really proud of, and with reason. Since 2007, they have increased the dividends with 123%. On top of that, they also pay a lot of supplemental dividends. In the last 12 months only, already $1.18 per share. The net asset value and DNI also have been increasing quite consistently over the years, giving confidence for the future ahead. And one of the things that is very important to me with companies like Main Street is diversification. You don't want the risk of being exposed too much to one industry. So that's why I like to see a maximum of 10% here. And the biggest industry is only 7%, so this is looking really solid. In terms of geo breakdown, we also see a nice diversification all across the states. Looking at the total investment income, we see that year to date this number is reported at 263.8 million, a 6% increase year over year, and the DNII reported also a 6%. Although there is still some decent growth, we do see a slowdown versus previous years. Looking at the income statement summary, we see that quarter over quarter there is a minor increase in total investment income, and year over year it is looking again pretty decent with 4%. Expenses did increase quite a bit with 9%, and because of that the DNII margin decreased 97 bps. Obviously, I would like to see things differently here. The DNII per share is down 4% year over year. And the interesting part is that net increase in net asset is down versus previous years. And now that we know a bit more about the company, it is time to check the fundamentals. But first, if you made it this far into the video, I want to thank you lots for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Main Street is a 4.2 billion market cap company. PE ratio is at 9.2, indicating they are undervalued. Later in this video I will show you my 3 price targets for Main Street stock, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 540 million, and in this graph we see that revenue went up in the long run. Of course, we see the impact during COVID, and most recently revenue is slowing down a little bit. Margins are going up and down in the past decade. During the lockdown periods, margins crashed, and after that they recovered pretty quickly, and most recently it is kinda stabilizing. EPS is pretty much the same story as the revenue and the margins, nothing special to add here. Analysts expect that EPS will decrease from here in the coming 2 years, which feels a bit random to me. I don't see a clear reason why this would happen, to be honest. And for the revenue analysis expect pretty much the same. And again, I don't see any signs of this actually happening. Especially the 23% decrease feels random to me. Return on assets is sitting at nearly 10%, which is a decent number. Return on equity is reported at 17.5%, which is a great number. This is also one of the most important numbers for Main Street. Current ratio is at 2.4, which is a really high number, and I would prefer a lower number here. And right now, Main Street has 2.2 billion in debt. And I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Main Street has 30 million in total cash, so they can't pay down a big part of their debt. To me, this could be a potential red flag. So, it is very important that free cash flow is growing, since this is used to pay down debt, of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is at a negative number most of the time. And to be honest, I don't like this at all. Last year it was finally reported at a positive number, but as of right now it is at a negative again. Shares outstanding are increasing in the long run, which is something that I don't like in general. But companies like Main Street issue new shares to raise capital, so I don't mind that much. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 8.4%, which is a great number. And keep in mind that Main Street pays a monthly dividend instead of a quarterly dividend. And this number is including supplemental dividends. The correct dividend yield for only regular dividends is 6%, which is still a great number, and don't get me wrong here. Annual payout is at $2.94 excluding supplemental dividends, and as of right now, a little over $4 when including these supplemental dividends. Payout ratio is at 69%, and I prefer 50% or lower. So right now they have 31% left in cash to buy back shares, pay down debt, do acquisitions, and all other things. The 5-year growth rate is at 3.9%, which is a decent number. And they have increased the dividends for 3 years in a row now, which is very nice. And if you take a look at these numbers, the dividends paid since 2014, you see that Main Street did increase the dividends at a decent rate. However, during the lockdown periods, they cut the supplemental dividend, which was a smart move, but ended the growth streak according to Seeking Alpha. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio used to be a bit high, but it is coming down a lot, which is a good thing. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at the same rate as the past couple of years. And overall these dividends look really good to me, but how about the historical returns? I decided to compare Main Street stock with the overall market, in this case the S&P 500. Next to that I added ARCC and Gladstone investment. On the 5-year chart we see that Main Street was beaten by the S&P 500 by quite a difference. In total, Main Street returned 68%. And keep in mind this is including dividends. The S&P 500 is sitting at 108%. And both ARCC and GAIN were doing a decent job with 81 and 87% return. On the 1-year chart things look pretty interesting. Main Street returned 30%, while the S&P 500 is at 23%. So Main Street not only managed to beat the S&P 500, but also ARCC and GAIN. On the 6-month chart, Main Street was again capable of beating the S&P 500 and the two others in this list. On the 1-month chart, it looks a bit messy, with Main Street actually having one of the lowest returns in this list. But all are at a negative number, so that's pretty interesting. And bottom line, Main Street was getting some momentum lately, but on the 5-year chart, the S&P 500 was still the winner, and most recently the momentum seems to fade away. So could this be the perfect time to buy Main Street stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 82, 84 and 86%. For the free cash flow margin, I'm putting in 26, 28 and 30%. For the PE ratio, I'm putting in 10, and for the price to free cash flow, I'm putting in 13, 14 and 15. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety with this company this time. And right now, Main Street stock is at almost $49. I hit analyze, and we see a lot of green numbers. And I'm more focusing on the multiple earnings value. We have a low price target of $53. We have a mid price target of $63, and we have a high price target of $72. And to me, the low to mid price target is the most justified here. So that means they are undervalued based on these numbers. What do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Main Street is that I love the business. To me, it is a high risk, high reward investment in a way. I really love the monthly dividends they pay with the supplemental dividends as well. And most fundamentals look good to me. And of course, there are some concerns with free cash flow margin, debt, and future outlook by the analysts. Other than that, most things look pretty good. From a dividend point of view, I really get excited with a high yield and relatively low payout ratio. From a value point of view, I also get excited, with numbers that show Main Street could be undervalued. Since this is a higher risk company, in my opinion, I'm trying to limit my exposure, meaning I'm waiting for a small pullback before I add more shares. Also to have a bigger margin of safety. In the meantime, I keep collecting the dividends and from time to time analyzing them. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.